Okay, so this is All Whites Limited, which is the 2023 service firm question. Um, All Whites are a dental clinic, so we haven't really seen dental clinics in the 100 mark questions. You tend to see them a lot in the 60 mark questions, but the process is the exact same. Don't get caught up with the shop and the private practice and so on. It's the exact same as any other service firm. So we'll be asked to do four things. We'll be asked to do the reserves, the profit and loss from the shop, the profit and loss account in general, and the balance sheet. And then we might be asked a little bit of theory around it and whether you think it's a good idea, in this case, to increase fees by 10%. So we'll have a look at all of that. As I said, it should be reasonably straightforward. So to do the statement of capital, we're looking at everything at the top of the question. Now, this line here, that all assets of 3 years accumulated depreciation, that's gonna be very important when we look at our fixed assets. So we have to reduce each of them by 3 years depreciation. The rates of depreciation will be given down at the bottom of the question down here. So the clinic is 2%, the equipment is 20%. Okay, so we start off. So the first one, the surgery or the clinic is 800,000. Now, what I do is I put them here. You can do them in brackets if you want, and then take away the accumulated depreciation in brackets, but I like to do it separately. So we've got 2% of 800,000 by 3 years. So we'll just multiply that out. So 2% of 800,000 will be 16,000. By 3 years, will be 48,000. So we're taking 48,000 away. And the value of your surgery then is 752. So our second one is equipment. That costs 130. Same process. We know the depreciation on equipment is 20% of cost. So it's 20%. 20% of 130 by 3 years. So we just do that sum. So 20% of 130 will be 26,000. By 3 years will be 78,000. Just check that. 130 by 3. Yeah, 78,000. So we do that calculation, and the value of your equipment is 52,000. So that should be all of our fixed assets, but there's loads more assets and liabilities. Contract cleaning prepaid. So we've paid that in advance. So it's into next year. So in effect, either the cleaning service is owed to us or the money is owed back to us. So that's a current asset. So if we're owed either a service or money, it's an asset. If we owe a service or money, it's a liability. So contract cleaning prepaid, the service is owed to us, so that's an asset. Stocks are always assets. So stock of dental supplies, 7,000. And then the shop stock is also an asset. That's your opening stock in the shop, 8,000. Creditors are obviously people we owe money to, so creditors are always a liability. So I'm just going to put them down now. My method of doing this would be to put everything in and total them at the end. So fees due from private patients, they're an asset. So it's money that's owed to us. So they can just go straight in. Everything here can go straight in, really. So that's 2-1. And then investment interest due, 800. Now, anytime you see investment interest due, I would write down investments first. Because for you to have investment interest due, you actually have to have investments. So we're going to have to go and work that out before we finish this off. Again, generally, anytime you've got investments, you've got investment income. Anytime you have investment income, you generally have investment income due in these types of questions. So last couple, the authorised share capital was 800,000 and the issued is 450. The authorised will go into the balance sheet. You don't have to do anything with it. That's just the amount of shares you're allowed to sell. Issued share capital is a liability. The reason being you owe the share capital back to the shareholders if you ever sell the business or if the business is ever wound up. So that goes in as a liability. Now, a couple of extra things we always need to look for. There will always be, well, you've got a bank account, so we have to have money in the bank at the start of the year. So the balance of bank is 54,000. It's a debit, so debit balance at the start of the year is an asset. We should then check for a loan. So it tells us there's a repayment of a bank loan plus 16 months interest at 3% per annum on the 1st of the 8th. So you pay this back on the 1st of the 8th with 16 months interest. So not only is there a loan, there must have been loan interest due as well. So we're going to have to work both of those out. So if we paid it back on the 1st of the 8th, that's 7 months interest this year, which means there was 9 months 9 months due at the start of the year, 9 months owed at the point when we should have done this account. So we have to work that out. Now, if I was having a guess at this, if I wasn't sure, I'd say nearly certainly the bank loan is 80,000, and then we can go from there. But we'll show you how you work it out. So there's my two things to work out: my investments and my loan interest due. So, so it tells us on the investments front. So it tells us that we have 16 months interest, and that's for 4 months. So so it's telling us that we got 4 months interest, so it's 16. So it's easy enough then. So the investment income per month is 400 a month. So it's going to be 1,600 divided by 12. Sorry, divided by 4 multiplied by 12, which will be 4,800. Okay, so the investment income is 4,800. I wouldn't. It's an interesting one. You don't have to worry about this 800 now, or you don't have to do any working for it, because it tells you specifically that this is 4 months investment income. So assuming, well, we know we're going to have the investments for a full year. We had them last year, so therefore we have them this year. So 4% is equal to 4,800. So therefore the investments must be equal to 100%. So 100% will be 4,800 divided by 4 multiplied by 100. So that's not that number there. I don't know why that turned it into a percentage. So just format cell. So that's 120,000. So the investments are 120,000, and the investment income due is going to be, well, we know what it is. It's 800. Now that 4,800 is investment income. Make a note of that, or if you want to, you can put it in your income and expenditure now. Just don't forget it. Anytime you have investments, you have investment income. All right. So, and then there will be investment income due at the end of the year as well, which we'll do when we get to that working. But just don't forget it. I might again write it in early so as I can't forget it. Okay. So that's my investments done. My next is my loan and my loan interest. So the loan plus the loan interest is 83,200. Now that's 16 months. So 100%, and it's 3% per annum, so 3% for 12 months. So 100% is the full amount. 3% is 1 year's interest, which is 12 months. And then we have 16 months, so 1/3 of 12 will be a year. So one third, or 4 months is 1/3 of a year. So 1/3 of 3% is another 1%. So 104% is equal to 83,200. So the 100% is the loan, 3% is 1 year's interest, and 1% is 4 months interest. So 104 is equal to 83,200. So we can just break that down. If we take that 83,200, divide it by 104, and multiply by 100, you get 80,000. So that's your loan. So that's the 100% is the loan. So I can put that in, and I assume it will be 80,000. The interest then is 3,200, of which we paid it back on the 1st of the 8th. So 7 months. That's 16 months. 7 months are for this year. So 7 months are this year's expense. Which meant 9 months were due on the 1st of the 1st. So we can just separate that. Take that 3,200, divide by 16 and multiply by 7. You get 1,400. Take the 3,200, divide by 16 and multiply by 9, and you get 1,800. So 1,800 is going in my liabilities this year. Again, if you want, into your expenditure, put the 1,400 straight away. Then you can't forget it. So I would imagine that's them all. It is them all. So just check and see there's nothing. Really, we're looking for things in the receipts and payments that indicate you had them at the start of the year. All right, so there's nothing else there. So we can assume that that's everything. So we're going to add up. We can always come back and correct. We're going to add up our assets. 993, 996, 300. Add up our liabilities, and then take them away from each other. So 461, 500, and that's known as our reserves on the 1st of the 1st. Okay, make sure to call it reserves on the 1st of the 1st. There often is a mark going for that. So that's the first part done. Now, I tend to do all of the rest of them together, but what I'll do here is I'll do the shop. Profit and loss account next. Ordinarily, as said, I would do the shop trading account and the profit and loss account and the balance sheet together. But just for the sake of this, I'll do the shop account first. So we're looking for shop sales. So sales are 53,000. Now, really important, you just make sure there are no debtors to do with the shop. Because like in club accounts, if there's debtors to do with the shop, you have to adjust sales. There is not, right? The opening stock from the shop is up at the top here, 8,000. The purchases to do with the shop are 31,500. Again, check that there's no creditors to do with the shop. There's creditors for dental supplies to the clinic, but not for the shop. And then the same at the bottom. There are creditors for dental supplies, but not for the shop. So you can put that straight in. If there were, remember, take away your creditors at the start of the year. Add your creditors at the end of the year. Your closing stock then for the shop gets taken away. So minus 6,200. And that gives us 24. Where am I going wrong there? Sorry, purchases. I took them the wrong way around. 23,000. So 24,800. Yeah, just be careful there. Take them away from each other. You get 28,200 as your profit. Now, from there you have to take away your expenses. Your expenses will always be listed, I used to say, in working 5, and it is working 5 in this case. So what I'll do is every mention of an expense here, I'll also put in my profit and loss. So make this a little bit smaller. So I've got wages here, which means I'm going to have wages here as well, just so as I can't forget them. Now the wages are 26,000 who also, but their wages and salaries include 26,000 to the secretary who also runs the shop, and 30% of the 26,000 is for the shop. So we're going to attribute 30% of the 26,000 to the shop profit. So that's 7,800. Now then in my expenditure, I'm going to write minus 7,800 there to remember to take that away. Next one then, 1150 of the insurance. So I'll go 1150. and insurance minus 1150. So it can only be in one of these. So if we put 1150 in the shop, we can't put it in expenditure, which we'll see why that is in a second. 1500 of the light and heat. So again, 1500 there, and then take away 1500 here. And finally, 600 of the telephone. Okay, and that's us done. So we'll just add up those expenses, and we're going to take them away. We get 17,150 as our shop profit. Now that shop profit is income for the business, so it goes in our profit and loss account under income. So 17,150. It should make sense why all of these numbers get taken out of the expenditure, because they're already included in the 17,150, so they can't be included two times. Okay, so from there, I definitely now do everything again from the top. So I'll start off off the very top and make my adjustments from there. So first thing is the clinica cost. Now that's the surgery. Now I know surgery is a fixed asset, so I'm going to put in my surgery into the fixed asset. So at the moment it's 800,000. Now I'm going to read the rest of the question and see if there's any mention of the surgery. Have we built an extension, for instance? Have we revalued? So if I look here, there's nothing on the debit side. There's nothing on the credit. I'll go down into my notes, see if I can find anything about the surgery. And it says on the 31st of the 12th, All Whites Limited decided to revalue the clinic to 950,000. So 950 here. There's no depreciation because we revalued at the end of the year. So I know I'm going to have a revaluation reserve, and I'm going to do that working now. So what's happened, right? So the surgery has gone up from its initial I'll do the depreciation. Where is this? Sorry. The first thing I'll do is I'll do the depreciation. So we're depreciating the 800,000 first. So it's 2% of 800,000, which is 16,000. Okay. So depreciation is 2% of cost. Right, that 16,000 is an expense. So I'm going to put that in my expenditure. Okay, now, but then we've revalued. So what happens when we revalue? We have to create a revaluation reserve, and into that goes the increase in the surgery. So it's gone up from 800,000 up to 750, isn't it? Yeah, up to 950. So it's gone up by 150,000. Added into that, you have to add in any depreciation that we've had. So our depreciation at the start of the year was 48,000, and then we had another 16,000. So that's 214 for a revaluation reserve. All right, so we're going to put in our 214,000. Which I'll put in my finance buy. So that's the land and buildings done. Second one I see is equipment. So now I know equipment is a fixed asset. So again, equipment starts off at 130,000, but we're looking to see if we've sold any equipment, which we did, and then we're looking to see if we bought any equipment. So if we sold equipment, it'll be on the debit side of the receipts and payments. If we bought equipment, it'll be on the credit. And there might be a note at the bottom. There could be a trade in, there could be anything happening. So come down to the bottom and see. So it says the depreciation policy for equipment is to charge a full year in the year of acquisition and none in the year of disposal. During the year, equipment which cost 15 was sold for 5.4. I'll deal with that in a minute. On the same day, new equipment was purchased for 27,000. So equipment is, I'll do a working just to make it clear. Equipment started off as 130. Now we're going to take away the 15. Now we're not going off this number here, the 27.5. We're going off the working. We're taking away the 15 and we're adding on the 27.5. Okay. So that's 142,500. So that's the cost of our equipment. Now, the depreciation of equipment, based on our policy, is that we're charging a full year in the year we buy equipment and none in the year we sell it. So the year we buy equipment is the first year. So we have the 27,500. We're not depreciating the one we sold of 15,000. So the depreciation is going to be 20% of the 142,500. Which is 28,500. So that's an expense. So we can put that in. After that, then we've accumulated depreciation. So what do we have? We have our starting depreciation, which started off at 78,000. Sorry about the movement around here. So 78,000. Add on this year's depreciation, 28,500, and then we have to take away depreciation on the one we sold. So that'll be 20% of 15,000 multiplied by the number of years we had it for. So we bought it for, we're doing the accounts for 2022. We bought it in 2019. So 2019, 2020 and 2021. No depreciation in 2022. So we have that for 3 years. So that'll be 9,000. So there's 9,000 depreciation on the one we sold. So if we don't have the equipment anymore, we also don't have its depreciation. So the accumulated depreciation will be 78 plus 28.5 minus 9,000, which is 97,500. Now, I hope you've learned, sorry, it's 97.5, so the value is 45. So I hope you know then, anytime you sell an asset, you either make a profit or loss on that asset. So we have to work out the profit or loss. Easy to forget about it in these types of questions. So to do that, we compare the value of the one we sold. The value of the one we sold is its cost minus its depreciation. So in this case, 15,000 minus 9,000 is 6,000. Okay. How much did we get? It was sold for 5,400. So therefore, it was worth 6,000. It was sold for 5,400. We made a loss on that sale of 600. So we got less than it was worth. And the loss is 600 euros. Okay, so always very important to work out the profit or loss on the sale. So this 5,400 doesn't go anywhere. It's just money we've received. But the 600, that profit, or sorry, 600 loss, then does go in. All right, so that's that one done. It's probably the longest working of them all. Now, from the rest of them, they're all really straightforward workings. What we're doing is we're accounting for what happened this year. So anything that happened last year or next year gets taken away, and anything that happens this year, even if it hasn't been paid for, gets added on. So the first one we see is contract cleaning, prepaid 400. So there has to be contract cleaning. So we have paid 9,200 for cleaning. We prepaid at the start of the year, which means it was for this year. So always add on prepaids at the start of the year. And then if there's any prepaid at the end of the year, you take it away because it's for next year. So we can go down and check the workings, and it's payable a month in advance, and we've paid 750. So included in the 92 is 750 for next year. So that has to get taken away. All right, 8850 then becomes your expense. Now, the 750 is a current asset, but I'll do that at the end. Okay. Stock of dental supplies for use in the clinic. So that's purchase of supplies. So if we've opening stocks, we're using them this year. If we're closing stocks, we're using them next year. So just all these done out from the previous question. So supplies or purchase of supplies. So we've got 31.5 as our purchases of supplies. We've an opening stock. So opening stocks are used this year. So we add them on. 7,000. And we have a closing stock at the end of the year, which get taken away because they're used next year. So that's 1,800 gets taken away. So that's the purchases of supplies would be 30. I have that wrong, have I? Just check that I have the right. So that should be set. Opening stock is 7,000. Closing stock 37.5. Just need to check that working. Sorry. And my own answer I've written down. I have a different number. So 7,000 plus 31.5 minus 3,000 is 36.7. Now, I just need to look here. Oh, here we go. So, just the importance of reading the question. You also have creditors for supplies. All right. So, if we've creditors for dental supplies at the start of the year, we have to take them away because they're to do it last year. And if we've creditors at the end of the year, we have to add them on. So if we go down to the bottom, we've bought supplies, but we haven't paid for them. That's 3.8. So we'll have to add them on. That's 37,500. I'm hoping there's nothing else in that, but I'll stick it in. So that's our creditors, or our stock of supplies. Stock in the shop has been done. The creditors is now done. Fees due from private patients 2.1. That'd be like our subscriptions or our income from private patients. Very like, say, your subscriptions to the gym or whatever in most other questions. So our receipts from private patients are 198,000. Okay. Now, if we have fees due at the start of the year, we take them away because they're due last year. So the fees due from private patients are 2.1. They get taken away. There's probably fees due at the end of the year. So fees received from private patients include 4.7 for next year. So that's fees into next year as well. So there's a prepaid. That needs to get taken away because it's not for this year, so it's for next year. Fees due from private patients and medical card schemes are 1,802.7. So the fees due for private patients at the end of the year are for this year, and that's 1,800. Okay, now so if I just add them up, I get 193,000. Now I'm going to put that in. Now I'll just point out something here in a second. So you're going to see here that the private or the closing bank balance doesn't take into account bank charges of 90, which I'll come back to, and a dishonour check of 950, which was received from a private patient in respect of work carried out in 2022. So in reality, now we'll deal with the knock-on effect of that. But if you think of this number goes down by 950, okay, but the fees due at the end of the year goes up by 950. So they balance themselves out. So that'll be 197,050, and this will be 3050. So the whole thing will balance itself out. Now we will have to adjust the bank balance at the end of the year, but in the case of this, the fees due, it's actually worth doing now. The fees due are 3050. Okay, so just make a note of that. So in our balance sheet at the end of the year, the fees due will go up to 3050. All right. So if it doesn't balance by 950, if you've tried this, that's the reason why. So fees from private patients, we've done investment interest due. I think we've done investment income already. Let's check my answer. We have. So our share capitals, we're going to put them in. I'll put them in. Our authorised share capital is 800,000. You do nothing with that, and our issued is 450. So that's everything from the top done. I might, or I will. Do you know what? I'm going to put in my investments now. If you have investments at the start of the year, you also have investments at the end of the year. Just another one that's easy to forget about. So the investments we worked out were 120,000. So I'm going to put them in my fixed assets now. All right. So I have everything from the top accounted for. Balance of bank, that's accounted for. It's in the accumulated fund. Receipts from private patients is done. Receipts from the medical card scheme is an income. So I need to put that in. Now, is there any adjustment to that? We'll see. So the medical card income is 106. If we go down to the bottom, fees, there's 2,700 due on the medical card scheme, so we have to add that on. So that'll bring you up to 108,700. There'll be nothing prepaid in that. So just make sure of that. No, there's nothing prepaid in that. So we'll put in that 108,700. Okay. Investment income, 1,600. Now I need to work out what the investment income is for the full year. So the investment income for the full year I've worked out to be 4,800 already. So I did that at the start. Sale of dental products in the shop, that's been done. Sale of equipment has been done. So light and heat is next, 8.3. So it's generally a light and heat working. So we start off with 8,300. There was stock of oil of 400. So that needs to get taken away. So the light and heat is 8,300 minus 400, so 7,900. Just check that there's no other light and heat. No other mention. There isn't. So that 7,900 can go into our light and heat. Now, at this point, you'll take away your 1,500 and you get your 6,400 for your light and heat. Okay. Contract cleaning is done, I think. Yeah. Postage 1,500. I think that there's no mention of postage at the bottom, so we can put that in. Insurance 6.3. Again, I don't think there's any mention at the bottom, so we can just put that in minus the 1150. I want to just check there's nothing on insurance. Yeah, that's fine. The purchases about done. Telephone and broadband 1900. We'll stick in the 1900 minus the 600 there. So it'll be 1300. Salaries 72 minus 78. There's no mention of salaries at the bottom. So that's 64.2. Equipment 27,500. Now I've already done the equipment working. Rates is 11.6, so that's an expense. So just checking, no mention of rates here at the bottom. There's often rates prepaid. We've done the loan and loan interest, and the balance of bank is going into our it's a current asset. Now we've 142, but we've a dishonor check of 950. We also have bank charges of 90. So it'll be 151. Or one. That's a mistake. 50. That should be 142. 14. That doesn't seem right. I'll come back to that. I'll come back to that one when I get around to it. All right, so that's I have to then just remember to put in my bank charges into my expenses of 90, and that should be everything. Okay, so I can then go down to my information at the bottom. All of this has to go into the balance sheet somewhere. Generally current assets, but not always. So you have your closing stocks. So we've our stock of dental supplies. There's no workings to these, you just throw them all in. 1800. We've our stock of products, our shop stock of 62, and we've our stock of oil of 400. Cleaning prepaid is an asset. Just gonna have to move all this down a little bit. I didn't give myself enough space. So the cleaning prepaid is an asset of 750. Then from the bottom, the fees received from private patients are working out. So fees prepaid, they're a liability. So I'm going to put them in my liabilities. So the fees for next year are 3.8. Sorry, they're 4.7. Fees due are 1,800 and 2.7, so I'm going to have to put the two of them in. So fees due are 4.7. Or sorry, fees due are 1,800 and 2.7. Nothing here that. Though this number 5 is the exception, none of that goes in the balance sheet. Creditors is 3.8. and the rest of it's done. Now I already can remember I've made a mistake with the fees due. So if you remember, I have to add on the 950 on the fees due to from the private patient. So instead of being 1800, it's 1800 plus 950. It's worthwhile doing that um, when you come across that working and rather than waiting. So it's 1800 plus 950. It's 2750. That just leaves me with the bank. So 142. Just get this right. 142 minus 950, and then minus another 90 is 140,960. And then our investment income due. So we're supposed to get 4,800. So I'll do this working. Um, so we're supposed to get 4,800. We've received 1,600. However, of the 1,600, if you remember at the top, 800 were 800 was to do with last year, so it was due at the start of the year. So we've only actually received 800. So we're of this year's amount, so we're due to get another 4,000. Okay, so I'm hoping that's everything in. We'll see if we can get at the balance. I'm sure I've made a mistake somewhere, but hopefully we can pick up on the mistakes as we go. So 323,650. We add up all of our expenses now. This is where, if I've left something out, it's probably in here. So 183,090. Just see, we'll take that away to get our net profit. Which is 140,560. Now what we have to do is add on our reserves at the start of the year. That's our answer from part A. So 461,500. That'll give you reserves at the end of the year. So add the two of them together. That gives you reserves at the end of the year of 602,060, which go in your balance sheet. So we'll put that 620,060 into our balance sheet, and hopefully that'll help us get it right at the end. So add up your fixed assets. And to those, add on your investments. Okay, add up all your current assets. There's loads of them. We might have had enough room, so you just have to manage that in an exam, I suppose. You get 159,560, and your two current liabilities will be 85, and you have to take them away from each other. Okay, 151,060. So that's a positive, so we'll add that on to the 115. Yeah, 1266060. So hopefully, if we add these three together, we'll get the same number. 128. We don't. So 6. That should be 602, shouldn't it? 602. Let me just check that. 602,060. So 1266060. So both numbers balance. So we can be pretty confident that we've got that right. So that's it all done, and then you got this little bit of theory, which you don't normally get in service firms. But anyway, you've seen this loads of times from club accounts. They're considering increasing the fees for its private patients by 10% due to increased running costs. What advice would you give? You can give any advice, but the thing is to work out what the increase in income is, right? So the income from private patients is 193. So a 10% increase would give us 19,300 extra. So you could say, well, you'd advise them to take that 19,300 because private patients can afford their dental fees. It would increase profit by 19,300 and so on. Or you could say that the company is very profitable at the moment. It's made a profit of 140,560. It does not necessarily need the increase in private fees. An increase in private fees might drive customers away, and they might seek new dentists, which could actually lead to a reduction in private income. Um, it is important for you always to say what you have in the bank. So in this question, we can say that they have we have 140,960 euros in the bank. And that includes after paying off a loan. We also say we have investments of 120,000. So they're in a really strong position as a dental practice. They've got investments, they've loads of money in the bank, and they're very profitable. They may not need to increase the income from private patients. If you want to say they should increase the income from private patients because it brings in money, you can say that as well. But generally, the advice would be for profitable businesses with money in the banks that they should not necessarily look to increase charges. So hopefully that's all right, and it's useful for some of you doing your leaving cert this year.